all of my stuff on. Start video.
Okay, yeah. Okay, okay. We can hear you.
Okay. There we go.
Our camera's off, but we can hear you. You just can't hear us.
Good. What I'm going to do on mine is just do one of our commercial backgrounds, so that's fine. And let's do the share screen just to
And then just at the bottom where it says polls, if you click on it, if you can see there, I have added just 3 questions, so you can just launch it when you're ready.
So I am not seeing the option of polls, and that was what I was worried about.
Oh, you're not seeing that?
No. What I have on...
So let me just...
Yeah.
Okay, wait. I'm making you the host now, so you should be able to see that.
Thanks so much. Yes, now I can see the polls.
Okay, so you can launch them as you like.
Oh, wonderful. Thank you so much, Kristen. Much appreciated. Here I see.
All right. All right. Just a moment. Are you going to then hold it?
Morning. I should get my glasses. Hello.
All right, so all is good. So you'll just wait for the delegates to slowly trickle in. I have sent out a reminder. And then, yeah, if you do have any problems, you can pop us a mail or give us a call.
Kristen, thank you so much. I am then just going to turn off my camera at this stage. I don't want to go out so that you have to reactivate me as a host. And Good morning, ladies and gentlemen. We'll be starting shortly. We're just waiting for a few more participants to trickle in. We have about just over the 50 that registered, so let's just give them some more time to get onto the webinar. Thank you so much. Good morning, everyone. Thank you for joining us for this webinar on funding that fits and identifying the right funding for your business. While we are waiting for a few of the other attendees to trickle in, I'm going to launch a poll on my side. It's always a good exercise for us to see exactly who we have in the room. It can be quite a lengthy presentation, so I want to make sure that I answer all of the questions and that we tailor the webinar today to your needs and where you are with your business. So if everyone can just, you would see a poll popping up on the screen, and I have 3 polls. I'm going to launch the first one, and the question there is, what type of capital are you looking for? What type of funding? I'm going to launch that. We have bridging capital, equipment capital, working capital, expansion capital. That would be anything that you would have in mind to obviously grow the business or acquire some more equipment. So equipment normally falls within the expansion capital segment as well, buyout capital, and then any other capital. If you could vote, that would be super. And just to get an idea of the lay of the land of the individuals we do have on the webinar. Thank you so much. I see we have one question in terms of the bridging capital. Bridging capital would be any short-term capital that you need, invoice financing, short-term working capital, capital to unlock purchase orders or stock. So just to answer that question in terms of bridging capital. Great. Just to share the polls, I hope that you can see it on your screen as well. I have elected to just share that. We have the majority of the room either looking for equipment capital, which is great, as well as working capital. And then we do have expansion capital as well. So that's good. That helps me to just zoom in on what we need to focus on to answer your questions. I am going to go through the whole presentation, but definitely focusing on this to make sure that we do cover those aspects. Thank you so much. We are then going to launch our second poll. This is the question is in terms of turnover brackets. It's very important for us to know where you are in terms of the life cycle of the company, as that would also influence what type of capital we will be able to access on behalf of the company. So if you can start voting on that, that would be super. Thank you. For those individuals who just joined, I see we had a few more individuals within the last 5 minutes or so. We are just doing a quick poll to see who we have in the room to make sure that we do answer all of your questions and tailor the presentation to your specific needs. So if you can, you missed the first poll, but that's no problem at all. Just tell us where the company is in terms of turnover, as that would influence the type of capital that we will be able to access, and also the type of capital that we will be focusing on today. Ladies and gentlemen, I see we still have a few individuals trickling in. I'm just going to allow for some time. I'm not going to go over. I think we should definitely kick off by 9:10. And it's going to be my intention today to also keep to the time. I know we have 2 hours, but I do want to release you earlier. But yes, so I'm just going to allow a bit more time for these individuals to also answer the poll. I have one more poll, and then we're going to jump right into the webinar. Thank you so much. Last round for all of the individuals that joined, if you can just answer on our poll, your annual turnover, below 1 million, between 1 million and 10, between 10 and 30, 30 and 50, and then plus 50 million would then be outside of the brackets of the classification of the SMME. So yes, if we can just have the last votes for that, I'm going to close that poll. And we will then move on to the last poll, whereafter we'll kick off with the webinar. So just some feedback in terms of that. The majority of the individuals in the room has a turnover of less than 1 million, where short on the heels we have the group between 1 and 10 million. So that's great. So just some feedback for you in terms of that. Our last poll, and I'm going to ask that everyone please vote on this poll. It is, how do you classify your business? Do you see your business as a startup, early stage, a growing company, or an established company? Thank you. Good morning to the new attendees that just joined us. I'm going to ask that you jump right in and just answer in terms of our poll where you classify your business as. Do you see yourself as a startup, early stage, growing company, or established company? This is very important for us to determine exactly what we will be focusing on today. The funding landscape is very vast and it can keep us busy for quite some time. So it's our intention to make sure that we do tailor the webinar today to the individuals in the room. As we are speaking, I'm seeing we have a few 40% being early stage and 60% being growing, which is great. And just some feedback on the two previous polls. The majority of the room was looking for equipment and expansion capital, and then short on the heels of that would be working capital. The majority of the individuals in the room as well, in terms of turnover, below 50 million. And so, yes, that also influences what capital we will be focusing on. So just sharing the last poll results, 33% being early stage and 67 being growing companies. Thanks for everyone participating in that. We have our parameters and we will then kick off with the webinar. Thank you so much. Great. I just want to confirm that everyone can see the screen. What I'm going to do on my side is just quickly launch the video so that we can have some introductions. Morning, everyone. Janae from Venncap. We are elated to be with you today. It is our first webinar with CISA, and we're really looking forward to continuing on this journey and hopefully getting all of the attendees on the right path of funding. It's my mission today to clarify a few basic aspects to help you identify where you are in the company life cycle, and as well as to help you navigate what would be the best route to funding for your business. That being said, let's jump right into the webinar itself. You are welcome, please, at any stage to post questions and answers. I want this to be a very interactive webinar, so I welcome all of the comments. And I see we do have some coming in. Thank you so much for the individuals just providing us with their answers who didn't have an opportunity to vote on the polls. It's noted. I see we have additional equipment and working capital. I did not understand bridging capital, so I would add that as well. Thank you so much. Thank you for sharing that with us. So not to delay us any further, I'm going to jump right into the webinar. As I said, please feel free to be active on the chat itself. And yes, thank you so much for joining us. Great. Contents for today and what we aim to cover for today would be the company life cycle and phases. That would obviously relate to one of the questions as we ask as well, where do you see yourself in the company life cycle? That is normally the best starting point to identify the best funding route. as different funders have different mandates, specifically catering for SMMEs, for growing companies, with different products as well. Your funding need, whether that would be debt or equity, so you're going to walk through that and look at all of the pros and cons in terms of what you as a company need to consider when considering debt or equity funding. We will then progress to the funding landscape. They will look at available instruments, rates, minimum requirements, funding, packaging requirements. So that's the goal. That's why everyone's here today. And hopefully we'll be able to introduce you to the landscape of funding and just broaden your horizon in terms of that. We're then going to progress to the financial analysis and ratios. There's specific ratios that specific funders focus on. Here we're going to look at the group of liquidity ratios, solvency ratios, and profitability ratios. From our side, we'll then take that over to a Excel model to just walk you through some of the normal high-level calculations we do when doing an initial assessment for the funding that fits, to determine, one, does the client comply with the minimum requirements, and then two, progressing towards the financial and risk parameters of this specific funder. And then we're going to continue lastly to what should be included in the business case. So it should be set off the bat that we don't need a business case and a financial model to unlock all of the funding, because that's going to be part of the funding packaging requirements. And that's definitely something that the company has to consider when applying, as this is professional services, and you normally do need to pay for specialists or individuals to then draft and compile those for you. So yes, that's going to be our high-level index for what we're going to cover today. We do have a special link available for attendees to access the MatchMe service for Mahala. So from our side, that's part of our partnership with SIFSA. We will be extending the link that you can access, and from Venncap side, we will then engage and give you a free funding that fits to help you on your way. So basically what we're doing here today, Venncap will be doing once you submit on the link, and we'll guide you through the process. Wonderful, let's jump into it. The race to profit margin hill. So in our analogy, you would see Venncap, we have a very bright colored and a different approach to it. It's not your normal black and white zebra funding platform. So we take the analogy of the race to profit margin hill. Here you would see the company life cycle. We have revenue and time, that being the two major aspects. And you can then identify the early stage growth. So we had 33% of the individuals saying we are early stage. That means we are still in the development valley of death, as we call it, and or we have launched our product, but we are not breaking even yet. Whereas we then go into the growth cycle, here we are breaking even, and we are growing at quite a substantial space. And then we go into the plateau of the established company. And here, in terms of the established company, you then get the opportunity to innovate, either tapering down or then taking on your second development curve in the exit window. So very important, as we said, where you are in the company life cycle will influence your need and the type of capital that can be accessed. Early stage, so we're going to spend some time on early stage and growth, that being the two major components of our attendees today. But I will also cover the established stage and the exit stage just to round it off and give you a good idea of the requirements and what we need to access in terms of that. So early stage in this leg of the race, we aim to, one, produce a product or a service and get the market to respond positively. So the majority of you in the webinar, I would presume that you already have your product and that you are now pushing towards commercialization. So here we have two very important aspects, that being, one, the ability to produce, and two, the offtake of our products and services to get revenue. That's why we are in business, so that we can make money. So do note that having revenue and being revenue positive does not mean we are breaking even, or that we have all of the bank cash rolling into the bank. No, it is literally for us to, one, have a minimum viable product, and two, have that product test positively with the market and getting traction within the market. So here we say, congratulations, you've got your business idea and you're ready to take the plunge. You have a lot to do in a short amount of time. The reason why we highlight that is time to market, absolutely competitive, and depending on your product or service, time is of the essence. So in this time, you need to test viability of the concept and get it to the market before your competitors. This stage includes anything from idea development to startup and making your first few sales. You're not breaking even, but you're getting there. So as we said here, you will need a well-defined product, very important at this stage, to do your market research, to look at your unique selling point, to understand why your product and the value that you're offering to the market is different than your competitors, and to differentiate yourself, and also to market that accordingly. In terms of this, we always ask, what problem do you solve for customers? What are their current frustrations? And we really implore the customer first approach. We have seen so many early stage companies knocking on our door saying, listen, I need funding. They have a brilliant idea, and by the time that we sit with them, we realize, and they realize, that they've been working in isolation on this product or this service or this project without taking a customer-centric approach. And that is all in vain, because at the end of the day, it is the customer, the market that needs to support the product and that should want your product. So our advice here is to look at your product, look at your service, and to start in the market, start asking people, what do they want, what do they need, and not to, in isolation, develop this product or service and assume that it is what they want. Continuously and actively be connected to the market in the customer-centric approach. So that will be the first, and then you obviously need to back your ability to produce quality products or services. This should be underpinned by a reliable supply of material and resources. So one question that all of the funders, it does not matter where you are in the funding life cycle, whether it is early stage, growth, establish, or exit, they will want to establish that you have various, not one supplier. The moment we have one supplier, you up the risk, and then any money or funding, whether it is debt or equity, becomes very expensive. So it's very important to also understand that this is to the sustainability and the benefit of the company, and also likewise then one of the mechanisms that we need to check and get in place, as this will add to the overall risk of the company, the risk profile. And when we are speaking about equity or about that, risk equals the premium that you will be paying or the company will be paying for funding. So the supply of materials, very important. Resources refers not only to money and time and actually having resources, raw materials. It refers to the skill set of the individuals as well. Very, very important. One of the aspects that will be scrutinized by funders and investors is the ability of the management team, the jockey as they call it in the industry, to actually produce and perform as they say they would. So this is the early stage. In terms of minimum requirements for this stage, you'll see we just highlighted and took a snapshot here of the valley of death. It sounds very doom and gloom, but this is the most difficult stage for any company to progress from research development to get to commercialization. And you'll see there's a back and forth between the market, the product launch. Is it sustainable? Can we meet the threshold? And not to run out of money at this stage. There's a very, very few and limited companies that give seed funding or early stage funding. And whilst you are in the research and the development and not gone to market yet, you are perceived as early stage and absolutely high risk funding. And we'll get to the funders in a moment that support the early stage funders. But here your focus should at all times be on proving and actively compiling a competent team to secure steady supply of inputs, to also have a minimum viable product. And as we said here, you don't need the final polished product. It needs to be something that works, that has stood its test in quality and reliability, and that the market accepts. So proven market interest also being a minimum requirement. And here it is advisable to define your target market, to understand who exactly is your market, and then to tailor your products and services accordingly. Cash flow positive, that would be the last minimum requirement for this stage. And once we have all of the tick boxes here on the right hand side, you have progressed through the early stages, and you would hopefully, if we've done everything right, be into the growth phase and really experiencing the growth of that. Great. So early stage pitfalls, correctly valuing and distributing founder equity. This is something we see very, very often. Founders are desperate to get the right people on board, which is good because it's very important. But what often happens is they do not have a clear understanding of the value of the company. And then also they say, and we actually call it a premature discussion, where founders normally go and say, okay, let's go 50-50, without really taking a moment to say who brings what to the table, whether it is resources, contacts, and or then the product. So incorrectly valuing and distributing founder equity, that's something we see quite often. Giving away large chunks of the business during the seed round, making future raising impossible. And I think this is something that we really want to just pause on. I just want to quickly go back here. It is a race. There's stages to the race, and where you're on the early stage, growth, established, and exit, understand that there's certain funding that you will need in your early stage and as you progress through the life stages. So be very cognizant of the fact that we do not want to give away large chunks of the business in the seed round, because that just hampers future funding and the equity component of that. Not having a clearly defined market for your product or service. We see a lot of people, also good products, good service, but not being in touch, as I said, with the customer-centric approach, and that wasting a lot of time, forcing them to go back to the drawing board, and then taking their company onwards and upwards from there. So incorrect market placement, not differentiating yourself from your competitors, not securing your company name, domain, IP or trademark. This is something that is so cheap and so easy to do, but a lot of people really neglect that. So please make sure that you do register the company name, the domain name. That's something, it's 199 Rand. And with all of business moving and progressing towards the online space, this is really something that we would promote and tell our, well, we do tell our clients that that is something that we do need to get in place. So please make sure that you, from the get-go, secure the company name, the domain name, IP and trademark. We've seen established companies being in business for quite some time, 10 years plus, where they've been trading, but they haven't secured the domain name, making it impossible for them to then progress to the online space, having to either buy the domain name at quite a steep a price from the holder, or then having to change their domain name to a different name than their trading name that they are known for and the brand that they have. Lack of accounting track record to reflect the value of sweat equity, value adding developments, profit and loss statements. So this is something that a lot of people miss, and we would really activate and promote that. Do keep accounting records from the get-go. I know you think you don't have a lot of sales but it's very important to record the value, what you put in, whether it is time, sweat equity, IP, and that stabilizes and strengthens the equity position when we want to apply for funding. So having accounting records, it does not need to be annual financial statements or audited as such, but to keep basic accounting statements is a real plus and something, an easy pitfall to avoid. Great. I'm not seeing any questions in terms of the early stage. I am going to progress to the growth stage. I see we have some attendees that logged on a bit later. Welcome, guys. Thank you for joining us. Perhaps just quickly share our lay of the land today, or the contents that we will be covering. We are going to progress through the company life cycle and phases. This is very important for us and for yourself to understand where you fit in, and you will then later, as we build on the blocks and the foundation that we're laying, understand why this is so important, and to identify where you are in the life cycle, as this will depend the type of funding that we can access and that is available to the company. We'll then be progressing on to debt or equity. That should be the next question. The funding landscape. We will then progress to financial analysis and ratios, and also then what should be included in your business case when you approach a funder. So our approach today is very practical, and please welcome to post any chats or comments or any questions that you may have. You are absolutely welcome. At the end, we will be sharing a special link specifically for CEFSA members, where we will then open up the Match Me, where Venncap will assist the companies in the webinar free of charge to navigate the initial funding fit. Great. In terms of the growth stage, that being our next stage within the company, the majority of the individuals in the webinar today has indicated that they are in the growth stage. So as you know, we have a fun approach to it. We say it's the race to profit margin hill. And in this stage of the race, you've made it to the main race. You are now revenue positive. And you've generated a few fans along the way. In other words, you now have some market traction, you have customers that support you, that come back and repurchase, and that's wonderful. But at this stage, you quickly need to expand your team and implement systems to deal with the demand. Good people and systems cost money, making the climb to profit margin hill a challenge that will need great strategies and additional investment to get you where you need to go. So this is obviously where the majority of the funding opportunities also lie, with some great funders out there really backing some of the SMMEs and companies that can show growth or expansion. So in this leg of the race, we aim to grow our revenue by penetrating the market, adding as much value as possible to grow our current customer base, and also decreasing the cost per unit. In other words, opening up or enlarging the pie, growing the revenue, whilst also cutting down on unit costs, equating to a growing profit margin. So here, to effectively service our current customer base, you will need to invest in the people and processes, as we said, and also ensure customer retention, optimizing operations to drive down unit cost. And although this is a very good high-level business assessment, is very important to understand that this is what funders are looking at and looking for when companies are in this stage. The growth stage will have to be backed by solid margins for them to back the business model, and that is very important. So in terms of the growth objectives, I'm going to start with the minimum requirements to complete the stage. All the requirements, obviously, of the previous stage, which would be the early stage. Here we at least need to break even, minimum 3 years operating, industry-related net profit margin, and sales growth year on year of 20%. So companies within the growing stage or are classified by between 15 on the lower end, but ideally 20% year on year growth as you then enter and grow your market share. So here, to ensure customer retention, and I have to tell you, a lot of the funders, especially the funders that team up for the long term with large amounts up until 25 million that they open up in terms of net funding. We obviously have the grants and the quasi-government funding as well. We'll get into that in a moment. They really scrutinize the management team and the value add to the industry and to your customer base. The analogy from that, or the science behind that rather, is that when you offer real value, your customers get a great customer service, you have convenience, and you innovate, you will get a return clientele. That directly connecting to the sustainability of the company, and as a funder or investor, sustainability of anything that you would be investing in is absolutely key. Here you will, in the growing, as a growing company, when meeting with funders, will have to be able to show a clear understanding of your competitors, where they are on the market, what is your unique selling point that you have, to understand what is your USP, compare that to your competitors, and be sure to differentiate that from what they offer to the industry and to the clients. Maximize margin. Specifically, if we're looking at purchase order financing, invoice financing, maximize of the margin is absolutely key. The margin is a direct indicator of profitability, and you'll see when we get a bit deeper into that in terms of the financial ratios. Market penetration. So here we need to focus on a higher conversion rate of quality leads. Remember, marketing is a marketing expense. As such, we need to make sure when we are expending money that we get a high conversion rate with quality leads. So that is also just supporting the drive down of unit cost component. Here also very important is to expand your team. As we are now expanding our volumes and the the sales and revenue and the operation in itself is growing, we need to make sure that we have the right team with the right culture. Very interesting. Two of the funders that we have on our mandate are highly focused on the culture of the company, the team, and they interview the team, and they want to make sure that they back the entrepreneurs with the right culture and with a mindset of sustainability, growth, inclusion. So that is not only a soft target or a soft element to consider, that is a component that is actively considered within the funding space. Higher grade managers, productivity and people, to ensure productivity of people and resources. Key individuals in the company is directly linked to the success and the sustainability of the company. Here, obviously, to optimize processes. As we optimize processes and productivity of people and managing resources optimally, this will also drive down unit costs. So this is the growth objectives for a company within the growth life cycle. You can now identify whether you are in the early stages or the growth stages, and also to understand what you need to be doing in the respective stages you find yourself in. Normally, the pitfalls we identify companies approaching Venncap for funding is that their business is not structured to scale. So this is a massive component and consideration by funders. When we are speaking growth, we want to be able to scale. So scale in terms of product, we need to be able to show that, one, we can up our volumes quite quickly. We have the resources, the services to then support the scalability of the business model and so forth. So scalability, definitely something to focus on, not benchmarking prices and services. I have one example. Originally I was out of the legal fraternity. And one of the firms that I worked with, brilliant firm, however, their prices, we always said we give 2000, back in the day, 2010 service, but with 1999 prices. So it's very important to make sure that you are market relevant, actively look at your competitors, where they are in terms of pricing, what additional services are they providing, and more so, you'll see when we get into the financials, we do benchmark the company and the ratios of the company against market industry. In the market, the industry standard, the benchmark of the industry. So that's very important. Not having an online presence, major pitfall. In today's day and age, if you don't have an online presence, do you actually exist? A lot of people, the majority of them, Google the company prior to inquiring about their services or visiting them in the natural sense, specifically within the manufacturing and engineering environment. Here we have return clientele, but that lead, converting the lead to a return client is normally a high price item. So have that online presence. It also boosts the perception of the validity of the company and the confidence of that. Growing operational costs, eroding the benefit of the scale of economies and profit margins. Very important as you grow to ensure that we do keep down unit costs and to make sure that we don't push volumes to the detriment of the profit margin itself. So that break-even analysis calculation there being very important. not investing in human capital and thinking the business idea makes the company successful. The company may have the best business model in the world. However, if we do not have the right team, we will not be able to execute. One of the most valuable assets of any company is surely its human capital. I know CIFSA has a great human capital department, and if you guys want to contact them and access that, please do. But it's very, very important to make sure that you invest in the components that will be adding to and taking the company along the growth spur. Not optimizing and documenting repeatable processes, stunting growth. Very important at this stage of the company. We have a lot of volumes coming in, and we now have the opportunity to streamline and simplify processes, yes, to add to turnaround times and to drive down unit cost, but more so also to ensure as we grow that we have an easier onboarding of new employees. Once we have a system in place, it is a lot easier in business terms, equating to cheaper because we are spending a lot less time. So we can now onboard and make sure that we have a standard going right through, again, connecting to customer satisfaction, connecting to the sustainability of the company, being important not only for you as an owner or as a key individual of the company, but being primary for any funder, whether it would be debt or equity. So that was the growth stage. You are welcome to post any comments that you might have or questions in the chat. As we go, I can pivot between the two screens. So if you have anything on the growth stage, please feel free to ask that. In terms of the established stage, not going to spend too much time here, as the majority of the individuals indicated on the poll that they are within the early stage and the growth stage. So established stage, you have weathered the storm, you've retained a good solid profit margin, and you have a strong, reliable team. With the experience under your belt, you now feel comfortable to explore new markets and opportunities. And here we should be focusing on succession on the horizon and to automate processes and systems. So here we already have the growing profit margin because we've driven down costs and we have ramped up revenue. Now we need to look, the company needs to look at diversification, whether it is upstream or downstream value drivers, a product range, unlocking new customer segments. And the main objective in this stage is to grow your market share. Establish objectives, scale, autonomize, extend the value chain, diversify your income streams, this being very important for funders. The moment we diversify income streams, we also then lower the perceived risk of the company. To give you an example, we might have a company with a low revenue and perhaps even a lower profit margin. However, they have a diversified clientele, and the diversified clientele, my apologies, and then actively paying them a few larger clients, a few smaller clients, and a good mix. Whereas if you have a company with major revenue and turnover with 3 or 4 major clients, that being perceived as a high risk, should one of the clients then default or switch to a different service provider or provider in general, supplier, that would be have a major impact on the company, and that would surely be flagged by funders within the space. So very good to diversify the income streams. hone your competitive advantage. By this stage, you should be comfortable with what you're doing, know your brand and your image within the market, and actively promote and market that, and focus on customer service, and that should be quality. So minimum requirements to complete the stage is 5 years in operation, have a growth of year on year 10%. You'll see that tapered down. While we were in the growth spur, it was 20% plus year on year. Here we are getting to around about 10%, tapering down to the plateau. Profit margins above industry standard, market share footprint, diversified income, and unlock the up and downstream value chain. So this would be more catered towards the companies looking at mergers and acquisitions, and looking to expand within the value chain. Pitfalls here: not understanding or capitalizing on the position within the market or in the value chain, not diversifying income streams, and uninformed expansion due to a lack of market research. I cannot stress this enough. It is absolutely pivotal and important that we at no stage lose contact with what is in the market, what do our clients want, what is our competitors doing, that being very important. So that would be the established component. Exit stage: well done, you're a strong contender in the market and you made it to the top of the hill. So you're at the end of the race. Here you have grown your market share, you have proved sustainability, and you are now ready for a high value exit. Being at the end of the current race, you have the option to exit and come full circuit to becoming an investor and reinvest in other ventures, or to take the company public or partake in a merger and acquisition. Very, very, very important here. And we see this ever so often, especially within the engineering space and the manufacturing space. You have one key owner or a key individual, and once we remove that individual from the company falls flat, and it makes the company we can't sell the company. The company might be worth a lot in terms of turnover but in terms of sustainability, it's not something we can take to market. Very important while you are in the growth stage already to be formalizing processes, to be appointing people, and to make sure that we do have that handover, you are able and that the company is able to then operate and function without the owner, the entrepreneur, or key individuals. Obviously, key individuals need to be active in the company, but at no stage should we not be able to promote or replace that key individual with a different set of skills. So this being very, very important while we are at the exit stage. Key personnel do not have a stake in the business. This is something that funders look at as well. They want to make sure that whoever is in the business has some skin in the game. This, especially as we are now progressing towards sustainability and the autonomy of the business, it is advisable to give key individuals, whether it is the CFO or the operations manager, opportunity to buy into the business, to have a stake in the business. Lack of well-designed systems and procedures. Well-designed, I cannot emphasize this enough. Systems and procedures add so much to the bottom line in evaluation. It is really worthwhile focusing on that. And poor corporate governance, this is something that is being overlooked quite often, and that makes a company unsellable. So it's very important to, while you are in the established to grow phase, obviously I would promote it from the get-go to say we should always be focusing on corporate governance, but this is especially key when we are exiting or getting towards that equity investment stage. So do ensure that you have good corporate governance, policies, company policies in place, and the right individuals to ensure that the company stays on path. Good. We are now at the second stage, or the second building block of the webinar, and we now need to establish the funding needs. So at this stage, if we just do a quick glance back, you should be able to identify where the company is, where you are in the company life cycle, whether you are in the early stage, growth stage, established, or exit. This being very important as we progress. It would be interesting to hear if anyone from the audience in the webinar, whether your position in the company life cycle has changed, as you indicated prior to and now after running through some of the information that we have done to date. Good. Thank you. I'm seeing a few comments coming through, identifying that they have actually moved in terms of the company life cycle after looking at the criteria that we just shared. Thank you so much. In terms of your funding need, the next question we need to be answering is whether you need debt or equity financing. Where you are in the company life cycle, as we said, will determine what we can and cannot access. When we look at an early stage company, it is important to realize that the main funders in this sector is government and quasi-government, being grants, research and development, angel investors, and such forth. Reason why is when we look at, and you'll see that now as we progress through this next segment, debt funders look for security. They are risk averse, although they do not advertise that. They want to take the least amount of risk for the best upside in terms of having a secured income, and so that is on the debt side. So you would hear it just high level there that normally does not fit your early stage companies. As we need a track record, we need to be able to show historic performance, and with the early stage companies, we are obviously pre-performance. We are commercializing, heading into the market and positioning ourselves. In terms of equity would definitely be an option here. In order for us to unlock equity in the early stage, it is very important to realize that the business model needs to be exceptional, the scalability needs to be exceptional, and we really, the equity financiers focus on innovation and what we can add from that point of view. As we progress into the growth stage, here we are ideally located to access debt and or equity, but mostly debt financing, and as we then progress towards the end, being established and exiting, we will then look at equity investment again. So this is just high level. We will be explaining some key differences and implications of taking on debt versus equity investment. And at the end of this segment, you should be able to identify and tick what type of capital we need to be applying for. Okay, in terms of debt, the meaning, that is funds borrowed from financiers without giving them ownership rights. On the other side, we have equity, that is funds raised by the company, giving investors ownership rights. From the get-go, it should be obvious here that we need to identify, if I don't have ownership rights, I have additional risk. I will then be charging you premium for that risk that I'm taking, whereas the equity investors are in it for the long run. They have skin in the game. They get both the rewards and the risk and the rewards equally. When we look at it from an accounting point of view, debt finance is a loan and a liability in the books of the company, whereas equity finance is an asset on the company's book. So I just want you to take a moment here, as this will be very important when we look at the own contribution and the gearing ratio of the company. More often than not, when we look at the calculations, we can see that the company is heavily geared, and that's normally above 60%, where they are heavily geared, seen as a high risk, and we know that we won't be able to access debt funding for them. When we then insert, let's say, the same amount, we need 1.5 million. When we put that into the equation of the debt equation, it is not possible. It drops the well, it actually spikes the debt to equity ratio well above 1, making it an unviable funding exercise. Whereas we take equity in for the same amount, that would often drop below 0.5, 0.4, which is great. So that obviously speaking to the assets that we take onto the books, whereas that is a liability. When we look at the duration of the two instruments or the two types of capital, the debt ranges from anything from 3, which is your short-term debt funding, to 24 months, which would be your term funding. Interesting here, and you can now think in terms of the business model of the specific funders. They get an interest rate per month. So the shorter the interest rate, or the shorter the term, the higher the interest rate and the risk. So that is the way they make money. The shorter 3 months sprints being anything up until 5% compounded monthly. And it's very important here. I should perhaps include that slide. We'll see if we have time to look at the ceiling. The ceiling rates that can legally be charged in South Africa in terms of the National Credit Act. This is split into a lot of segments, but the moment we are below 12 months, the interest rate that we can, that funders can legally charge spikes up until 12% per month compounded. So that is really, really high, and that's something we need to consider. So when we are looking at funding, if you can afford, and affordability is absolutely key when we're looking at debt. If you can afford, and let's say the instrument is packaged in that way, for instance, your invoice financing or your purchase orders financing, that would be viable in 3 months. However, if we're looking at operational capital or growth capital, we would then definitely be looking at a term finance or debt instrument there. Normally the term instruments, and we'll get into all of the parameters of that in a moment, are a lot lower, as low as 2% per month. So you can obviously equate that, and that would be 24% per year. That's the highest that they can go. So a lot of the guys do a prime +5 to a prime +8, which suddenly becomes a lot more viable. So that's your horizon periods for the debt. When we look at equity, and equity, we have to understand that it's a long-term finance. So this can be anything from 3 years up until 24 years, depending on where what type of asset we are acquiring. When we look at property finance, that's normally towards the higher end of it. Normally there, depending on the type of funder, if it is a SMME funder, they would like to exit for commercial property within 10 years. Whereas we look at the normal, the conventional, the banks, they are obviously in it for between the 10 to 30 term period. So that's just important to know. Status, when we look at the status, at the different instruments gives different rights and obligations. So the debt financier is a lender to the company. They do not have any standing as a shareholder, but the equity financier becomes a shareholder and an owner of the company. So that gives certain rights and obligations to investors, and they often require a board seat depending on the size of investment. So when we're speaking or we're looking at anything below 5 million, that would not warrant a board seat. But when we look at investments 5 million to 200 million, that would surely require a board seat, depending obviously on the risk appetite and the involvement of the specific equity investor. When we look at the risk component of this, debt falls under low risk investment for the investor, and obviously not for the business. This is a high risk for the business because you have somebody knocking on your door and demanding payment regardless of whether you made profit or whether your customers or clients performed and paid as promised. So this is a low risk investment for the fund itself, high risk investment for the company. On the flip side, we have the equity. This is deemed a high risk investment, so their risk appetite is a lot more flexible and larger than debt, and they are open to back risk business models as long as the rewards are exponential. So here they often refer to a multiplier, and that is something we'll dive into a bit later when we get to the financials. But your equity investor would definitely, if they're going to take in a high risk position, that will need to be substantiated and backed by a business model with superior returns, and also the multiplier connected to that, scalability being key. When we look at returns, debt lenders get paid to interest over and above the principal amount financed. That would also normally be interest component charge on the outstanding amount, whereas equity, equity gets shares, so that's directly connected to the shareholders, and there is a dividend connected to the profit earned by the company. Shares in the risk and reward, they only get a dividend if a profit is made, whereby debt, where they demand payment regardless of profit. That's why debt is a high risk investment for the company, or a high risk funding mechanism, whereas equity, being an asset, would be a lower risk for the company as they are connected to the profit of the company. The repayment terms of debt versus equity. So debt, the interest payable to the lenders is normally fixed and regular and also mandatory. Nothing we can do about that. Whereas equity, the dividend paid to the shareholders, is variable, irregular, and is completely depends on the profit earnings of the company, and also the dividend policy of the company, which is then decided normally when we look at the MOI of the company. You would have the clause saying it will be determined and distributed from time to time as then decided and within the discretion of the directors of the company. Here you can see normally why an equity investor would then request a board seat or to be appointed as a director of the company, as this gives them a certain amount of control over the dividend policy and to ensure that the company is being managed correctly and actively to then derive a profit from their investment. So that is the repayment terms when we look at debt versus equity. And here we have, lastly but not least, the security that is required by debt versus equity. when we look at debt, security is often required in order to secure the money. However, a number of companies raise funds without giving security. So this would also depend on the type of debt funder we approach and the amount that we would want to unlock for the company. Short-term debt funders are often high risk. They are unsecured, and that is obviously reflected in the premium of interest that they charge legally on the amount of the loan. Whereas we go towards the term loans are lower interest rate over the spaced out over the term of 12 months, 24 months, up until 48 months is the highest term that we have accessed in terms of a debt component when it's not linked to equity. And also not linked to property, because the property loans are extended for a longer period of time. But yeah, that would definitely, they require security over the long term. When we look at equity, once again, equity, shareholder ownership, connected to the risk and reward of the company. As such, there's no security required in the case of investing in a company, as shareholders get ownership rights. So often debt funders limit risk by requiring some security, which may not be possible for early stage or growth companies. We mentioned that when we started with the second segment. So unsecured lending has very high rates to offset the risk for the funder. So the takeaway here and the building block that we need to establish here is what would be a good fit for your company. Are you open to debt? Are you open to equity? And whether you are open to it or not, is it a feasible option for your company? So debt is largely aimed at companies that can prove, one, growth, has a sustainable cash flow and or expected cash flow. So we recently onboarded another funder, a very interesting business model. They solely do debt and extend debt, but they are open to risk and they do back the entrepreneur. So there they would be looking not necessarily at historicals, but they are willing to look at the expected and the projected cash flows. And they actively partner and get into the business. So that is one of the only debt funders within the space that really entertain early stage. And when I say early stage, I see it on that line, the progression between early stage and growth, with a lot of upside, and not only XL millions. So XL millions is what we in the industry call, you have one of those hockey stick return and turnover graphs. So it's very important here to make sure that we can substantiate it with letters of intent, offtake agreements, market research. They will not entertain a willy-nilly. This is our projection, so we do need to substantiate that. When we look at funders, they often look for high multipliers and return, as we said, and they are open to risk if it is justified. And that again boils down to the letters of intent, the contracts. Do you have a contract? Do you have purchase orders? We do need to substantiate that. So depending on where you are in the company life cycle, you'll see the green patches are equity and debt being straight in the middle, catering more towards the growth and established companies. So at this stage, you would be able to identify where you are in the company life cycle and whether you would want to access debt and or equity. Good. If we can take, I see we have been on for an hour. If we can take a 5-minute comfort break, I see 5 minutes, sorry, I see, yes. A 5-minute comfort break, I see somebody requested. In the interim, if you have any comments, please do put that on the chat. I truly do enjoy all of the comments. Vimbani, thank you so much. Joseph, I see there's a few people that's been commenting. Ellen, please feel free to just comment or provide us with any questions that you may have at this stage. We will then be taking our 5-minute comfort break, and I'll be starting at 10:18, if that is in order with everyone. Thank you so much. Great, welcome back, everyone. Thank you for some of the questions. Ellen has a question saying, hi, how do we apply for these funding and what security is needed at the early stage and also when to repay the loan. Well, thank you for everyone for staying tuned and still being on the webinar. I know everyone has hectic schedules, ourselves on this side as well. But Ellen, this is going to be answered in this segment of the webinar, where we'll be diving into the funding landscape, exactly detailing what security is needed, what ownership contribution is needed, what the minimum requirements are in terms of the financial and risk parameters, and what will be the expectation in terms of loan repayment. So we are going to dive into that, and you are welcome to extend any additional questions that we have not answered or that you need some more elaboration on. Thanks. Great. I hope everyone is back from the comfort break. Here we are on the next building block, which is the funding landscape, and this is the gold. This is what everyone wants to hear and why you are on the webinar. We want to know what is our options in terms of funding, and also what is the requirements for us to access this funding, and what is going to be expected of us as a company. So by this stage, we now know in which company life cycle you are, and you know whether you would be able to apply for debt and or equity. The type of funders that we have at the, on the landscape here, you would see we have identified government and quasi-government. That will cover both equity as well as debt and grant funding. So grant is money, is mahala money. There's no repayment connected to that, and that is the best type of money to get. You can think that that obviously pushes a return on investment through the roof, because we now have access to cash that employs and creates a return for the company that we have not paid for. So that is, if you can access that, that is great, and we will park a moment and just spend some time on that as well. Here you would see just some of the main funders within the government and quasi-government space. Quasi-government being they are partly privately funded, however, they still fall under the structure of government. So here you would see the IDC, that is the Industrial Development Corporation. They are the largest funder in the space in terms of funding, covering projects up until 1 billion rand. They are also open up into Africa, and the mandate for all of the government and quasi-government being empowerment, upliftment, a large component focused on BEE, but we'll dive into that in a moment. You'll also see the National Empowerment Fund and CIFA, not CIFSA. They have smaller programs, still very impactful, up until 25 million. And then you see the DTI, the Trade, Department of Trade, Industry and Competition. So they also have a few projects focused a lot on the R&D side. So early stage would definitely find its place with DTI or CIFA. You will then see that TIA, Technology Innovation Agency, wonderful grants available for technology orientated projects. And then the Innovation Hub, they would fall within the quasi-government sector. They are located in the east of Pretoria. It is a government or a provincial rather initiative. They offer wonderful incubation services, grants for research and development of entrepreneurs, of the business model. They really do partner, and this is done in a competition format. They onboard I believe it's every quarter. They onboard between 5 to 50 companies. So I see just the text there at the bottom. It's 5 to 50, just for the readers. So that being definitely something to explore if you are very, very early stage. You can access all of these government and quasi-government funders on their website. Short-term debt, we have a range of funders on our mandate as well. There's way too many to post all of their logos, but this would include your commercial banks, SME funders. There's been a lot of funders within the space. You'll see Lulaland and a few of the guys opening up the commercial viability and quick access to this, and then short-term loan facilities that is done either by family corporations or then short-term facilitators. Also, there's a lot of guys in that space. When you look at the private and venture capital space, you'll see we have the Southern Africa Venture Capital and Private Equity Association. All of the major funding houses are listed and associated to the Venture Capital and Private Equity Association. We have just, I believe the last time, just over 80 companies listed in South Africa. The venture capital and private equity side in South Africa really developing quite well over the last few years, and a lot of them actually being more tailored towards venture capital, which is fantastic. From our experience, not all of the private equity houses list with the association, as this is family offices or a consortium of businessmen looking to invest in eligible businesses. So let's jump right into the funding landscape. We're going to start off with government and quasi-government funds. Instruments available, Ellen, and to all of the other guys within the early stage segment, is grants, as we mentioned, no repayment requirement, debt financing as low as 4% per annum. That is free money for all intents and purposes. Equity and quasi-equity structures, what that means is the IDC or a few of the players within the government and quasi-government funding section would more often than not extend debt and then secure it by an equity vehicle, being a cession on shares, or for instance, we recently, well, not too recently actually, we assisted one of our clients. They set up a mill around about 80 million. We completed their financial modeling and business planning and the whole packaging of that, and then assisted them to apply on a bridging grant between DTI and IDC, unlocking a large component, about 25% of the 80 million in a grant, and the balance of that being supplied by the IDC. What they would more often than not do, especially when we look at the manufacturing and the large processing component, they would pay the supplier directly and then keep a cession or a short-term ownership of the project and its equipment up until sustainability, and the term connected to that is normally 3 years. So within that 3 years, the company is not allowed to have any shifts or movements in shareholding, ownership, or equity. They also offer bank guarantees. Often when, and we've experienced that now, at the end of the financial period being January, Feb this year, while the government was waiting for Treasury to announce their new budgets, they did not have money to expend or invest. So in that instance, they would then provide a bank guarantee to the specific project, and that would enable the owner entrepreneur project to then access funds through a conventional or traditional structure like a bank, but that being backed by government. So they do offer bank guarantees, trade finance, they offer that as well, development finance and equity and venture capital. They do promote that they offer venture capital, but I would really put that in inverted commas. That is more in terms of their grant funding, that would be TIA and a lot of the innovation focused mandates from the government funds. Here, it has to be highlighted that unfortunately, not everyone is equal in terms of being able to access the funds. There's a large focus on the BEE empowerment. The business model or the business plan submitted have to actively demonstrate job creation, innovation. They support green technologies, economic growth and rural development. It's not all of the above. It is either or, with a different impact ratio and scale being awarded to the company. I want to highlight here, I know we've had a few recently, we've had a few clients really voicing the fact that the BEE requirements are so strenuous that it's just not possible for them to get funding, and where they really have great innovative products. And I do want to tell you there's a misconception. The minimum level BEE requirement is a level 4, which is definitely attainable for the companies or the individuals on this seminar. We are well below the 50 million turnover mark. So everyone within this discussion would automatically then be a level 4 BEE. So I need to stretch that you do not need to be a level 1 or 2 or 3 level BEE. You can come to the table with a level 4. We just need to understand, and we'll get to the rates in a moment, that your impact ratio on the components as you see them on the right hand side there under focus, that will impact the rate that the government and quasi-government funds offer. So best case scenario, you will get a 4% rate over a term of 48 months. That's the best case scenario, and that then also going up until I believe a prime +2, yes. But we'll get to that in a moment. So requirements here, minimum level 4 BEE. Very important, and you'll see this across the spectrum from all of the funders, is the own contribution equity of the business. So government and funders, investors in general, wants to back projects and entrepreneurs that have skin in the game. If you come with 100 million rand project and 100% or 80% of that is debt funding, it's not your money. So your risk associated to that, you don't mind if you don't mind too much if it all goes belly up, because it's not your money. So you will see the own contribution requirement being levied here is at least 30% when you interact with government. Sorry, I see we have a hand raised, Mr. Vimbani. I'm gonna just allow you to talk.
Hi.
Hi.
I just want to find out from you, man, because I saw that you talk about TIA, and some of these government institutions, CIFA.
Yes.
For instance, I will say when it goes to the green technology, you find that you are having a waste management company, and to my waste management company, you find that you are collecting all the recyclable waste, But now the challenges that we are facing, you find that these big companies, what they do, they give you a containers whereby the pricing of your recycled waste is determined by them, whereby if, let's say, they said for 3,000 kg of a certain material will pay you 800 rands. Now you find that you are still, but you come to these places like CIFA, DTI, and I think, and also National Empowerment. Can't we, guys, we close, because we find that the challenge that we are facing is the transportation of our product to the person who can give you a better money in terms of the value of your recycled waste. For instance, if the kilogram of a cardboard is 3 rand or 350 to 4 rands, but now these big companies, they come and pay you 50 cents for kilograms. Do you see our companies growing?
No.
You understand what I mean?
I understand. So I'm just gonna, Mr. Mbani, I'm gonna answer that question.
Okay.
Where you are at the moment, and that would be different for each and every attendee on the webinar, is that boils back down to the business model. So you are 100% correct. If you can demonstrate that you do have offtake, that you do have a viable business, but that you are being hampered at the moment due to the monopoly in the industry, and some of the larger players, obviously you being a price taker, as you mentioned now, they offer you a specific amount per kilogram, and you have no other option to take it because you do not have infrastructure or transportation, logistics, and. So that will be an expansion need, and that would definitely, depending on the business model and what we can prove in terms of offtake be something that you can approach government and quasi-government funding, whether it is TIA, DTI, CIFSA, IDC. We'll get into some of the programs they have in a moment. They do have specific programs. They do have waste management programs as well, where they then put forward debt or equity funding for infrastructure development, specifically within the space. So you are in good company regarding that. And your main challenge there would be to demonstrate your current profit margin, and that being hampered due to the position you have within the market, and then the possibility that of the profit margins you would be able to unlock should you have your own infrastructure and logistics and that you need to grow. So I hope I answered your question. I believe I have. Thank you. Thank you.
Can I just add something? You know, the reason that you said if ever I have something to prove, or I will make an example to you, because you do this, then you see that you are failing, because at the end of the day, if you are losing, for instance, you are having the people that you are working with. For instance, I'm in a township. So as in a township in Western Cape, it's called Lower Crossroads. So it is there are quite a few shopping malls around me. So I used to rent a place, but because I can't manage to rent this place anymore, because when I look at the finances that coming in and the finances that are going out in terms of the price I paid and to the people who are selling me the cardboards and also the cans, I'm running a losing business.
Yeah,
so
it's
now
not a viable operation.
Yeah. So now again, it needs. I did my reviews in terms of the business model. You understand? But I noticed that the main thing that is my challenge is to get, for instance, if I can get a transportation for my products, I know that the challenge that I have, it can be fixed.
Mm.
So it's
Yeah,
Sorry?
Mr. Mbani, what I'm going to do is that's definitely something we can tackle on a one-to-one level, because that's
Okay.
something specifically towards your company.
Yes.
But 100%, if the business model makes sense, and you have one or two obstacles specifically towards the infrastructure, transport, and you are definitely within the right company, specifically within the industry that you are in. Waste management is a key focus at the moment. It falls within the green technology space, and the development and the mandate of government to extend money in that portion. So definitely, if we have a solid business plan with solid off takes and viability, but we just need to get access to infrastructure and transport and equipment, you are definitely in the right space. So it's going to be my advice that we will be extending a link to all of the attendees after this session, and I'm going to request that you then complete that link, and our company will be in contact and see if we can then guide you through the process and see where we need to work on the business model and what funding would be a viable option.
Okay. Thank you.
Thank you so much. Good, thank you, Mr. Mbani. So in terms of the government and quasi-government funds, that is where we are in terms of that. Innovation, green technologies, tax compliant, that is one of the requirements from them as well. Compliance with international and environmental standards, and the project must exhibit economic merit in terms of profitability and sustainability. So that's going to be requirements for all the attendees to access, minimum requirements. When we look at available rates, government obviously has the mandate in terms of their focus elements that we now have highlighted, and they need to deliver on that mandate. To do that, they have rates that range from as little as 3% to prime plus 4, and it works on an impact scale, considering the impact of the project that it would have on the, just going back, the rural development, the economic growth, green technology, innovation, job creation, and BE empowerment. So there is an impact scale in terms of that, and there's a point system that the applicant will go through, and depending on that, that would be the rate that would be achievable by the applicant. So here you would see we took the BEE levels. That's just a simple example, and that would then be specifically towards the scale in terms of level 1 to level 4. So here you would see a level 4 BE receives a prime plus 2. However, that might be lower depending on the job creation, rural development, and the innovation or green technology components that you work on. So it will be an average of all of the combined impact metrics. Application and packaging requirements. First of all, I want you guys just to look at the sticky note there on the top right-hand side. Timeline here is 3 to 6 months. So if you need quick capital or urgent capital, that would more be tailored towards the debt funding side. So please do keep the timelines take that into consideration. The application and packaging requirements, here you'd see a full registration documents, income tax and VAT, if it is applicable VAT. Income tax is always applicable. We need to prove compliance with that. Registered proof of address of the company, tax clearance, ID, copy of ID. I'm not going to go through all of it. So they have a few of the initial documents, but the main thing we need to focus on here is the profiles of the shareholders, the members, directors, senior management, and key personnel. They want a full diagram and organogram of the skills within the company and the jockeys that will be driving the business model. This will be supported by a comprehensive business plan, meeting the respective funders' requirement. We will be, after this slide, we'll show you a few examples of some of the programs that is available. They have each program has a specific requirements that needs to be detailed within the comprehensive business plan. And specifically when we are unlocking grant funding or government funding, they have very, very stringent auditing and fraud control. So the due diligence process is quite extensive, and the vetting process of the business model and the business plan is extensive. So this will need to be a comprehensive business plan meeting all of their requirements. So this would typically range anything from a 30-page to 60-page business model. So the production process, the description, the process flow, diagram or images, that's going to be required. A copy of the factory or building layout, specifically when infrastructure capital is being accessed. Identification of key suppliers and quotations of all raw materials and inputs. This must not be older than 3 months. 3 to 5 year financial model, providing insights into the related cost and impact on revenues, and a due diligence pack. Government from our last handover now to the new financial year have communicated that they have launched a new segment, auditing team to prevent fraud. So prior to dispensing any funds, they send out a 1 to 3 man auditing team, auditing various aspects of the business, whether it is the technology, the finances, or the operations. They really do dot their I's and cross their T's, so that should be noted when applying for government funding. You will be scrutinized on that, and we are glad for it, because we want to see funding going to eligible and sustainable businesses, and not to fall within the fraud and corruption element that we are all too used to. So that would be the government funding. Here we have a few examples. We will be assisting all of the attendees on this webinar to see what specific projects will be a good fit for them. But here is some of the examples: the machinery and equipment grant, or financing by IDC. This is a BE leveraged acquisition. It's aimed at large infrastructure investments, financing options available to various manufacturers to create a competitive and diversified local machinery and capital equipment industry. So this would, Mr. Mbani, also include the green space. The complex structural metal products and equipment used in industries. This was now specifically for a client within the metal manufacturing space. And they do support any manufacturing of agricultural, food processing, forestry, textile, apparel. Included in that would also be waste management. Criteria here was compliance with international and environmental standards. Shareholder ownerships are expected to make a financial contribution. In this case, you would have to contribute if you want to access let's say 10 million rand, you will have to at least at a minimum bring to the table 3 million rand. That can be in the form of property, of equipment, of business plan, sweat equity. You can see now here how important it is to ensure that you do your accounting from an early stage to prove your contribution and own contribution in terms of that. So please bear that in mind. They do offer preferential treatment to previously disadvantaged individuals if they do have a very good business model. So there are exceptions on the shareholders and owner contribution. The project or business must exhibit economic merit in terms of profitability and sustainability. This is not an option for refinancing assets. Minimum level 4 BE for acquisitions, and the acquisition policy will apply. So this specific apologies, it seems we just had a break there. This specific product is a minimum equity amount of 10 million. So it's aimed at larger infrastructure projects, and submission requirements is a latest or audited financials, comprehensive business plan, a full financial model, and a basic due diligence pack that would also include the documentation that we have listed in the previous application packaging requirements on the previous slide. Manufacturing competitive enhancement program. This is a scheme that provides working capital as well as plant and equipment finance. This fund size is quite large, 1 billion, limited to 50 million per applicant, fixed price at 4%, which is great, maximum term being 48 months. And also that being on milestones and drawdown. So that being very important. Criteria here, you either need to be a level 4 when you apply, or need to achieve that within 24 months. This is a blended finance that is offered between IDC and DTI, and it is applicable to manufacturers under standard industrial classification code 3. So you can just have a read on that, but that includes more or less everyone within the manufacturing space. So that's another example of one of the options. Here we have the Small Enterprise Finance Agency, SEFA. They offer term loans, anything between 50,000 and 50 million. Here it's all aimed at South African businesses. The owner must be actively working in the business. They must have a solid business plan and budgets and can afford the loan. So in terms of debt financing, the major thing is affordability, compliance, and preference will also be given to the disadvantaged business owners, and must result in job creation. So you'll see a lot of the government and quasi-government options focus on the mandate of empowerment, job creation, green technology, and everything that we mentioned at the get-go. When we get to debt funding, I just want to just quickly finish off this. Again, I want to highlight government is focused on the BEE component, which is great, but that should not make other business owners who do not fall within the BEE requirements despondent. We do have investors on our side, black investors that bring the BEE component to the table, that is open to innovative and profitable businesses. And we can blend and structure finance and do a joint venture or a collaboration of some sorts between yourselves and the investors on our books, should that meet the requirements or their mandate. So I don't want some of the attendees on the webinar to say, but I don't have the BE to bring it to the table, or we are so large that our supply chain and development places us at a level 5. Please do not let that hamper you from applying. Okay. In terms of debt funding, instruments available, growth funding, specialized asset finance, bridging finance, working capital, equipment finance, inventory finance, purchase order finance, debt restructuring, trade credit offered to your clients. So let's say you are a manufacturer of large items or large pieces of equipment, and they are quite expensive. We do have debt funding solutions that can offer and extend funding to your clients to enable them to then buy your products. So here they focus on affordability, the management team, the business model, profit margins, and the current debt and gearing of the company. Venncap, from our side, we have 5 mandated short-term funders. So we have mandates with these funders, and we then prepare and submit qualified deal flow to them. Once we've assessed and we've performed a funding recommendation on our side, we will then confirm what would be your options, and once we receive instruction, we then apply on behalf of the client. However, you are also, of course, welcome after this to, once you have understanding, to apply to some of the short-term funders out there yourself. From our side, we understand what they want, how they want it, and we just shorten rather the application process and the probability of success. So that's in terms of the debt funding side. Here, we went back. Here we have the requirements being the debt to equity ratio cannot exceed 0.6. Anything over 0.6 would be seen as over leveraged. Own contribution equity of at least 40%. Security and personal securities are often required. This is not required by the short-term funders of 3 months, but more of the annual term loans, VAT and tax compliance, and the project must exhibit economic merit in terms of profitability and sustainability. As we said here, affordability is key, and that will be one of the main calculations that we should be focusing on to see what debt funding you can qualify for. Here I want to highlight that debt funding is primarily aimed at growing and established companies. However, should you be accessing government or quasi-government funding, they also offer debt funding, and they have a lot more flexible terms and preferential rates. In terms of debt funding, Ellen, I hope that this will be answering some of your questions. The rates available, and this is just on an average risk profile. Obviously, each loan application will be assessed on its own merit, considering and weighing variable factors such as the rates, and as such, the rates that we have stated herein is for indicative purposes only. So you will see short-term operational capital. That's normally over 3 months. As we said, the shorter terms are unsecured, and they have a higher rate of interest that they charge. Please note that this is 3.5%. Normally, that's more or less the parameters per month, compounded per month, and that will be charged on the outstanding amount. When we refer to compounded per month, it means interest plus capital, and the outstanding component of that will be charged interest on as well. So it's not only on the capital. Short-term expansion capital, more or less 3%. Revolving invoice finance, 3.5%. Revolving purchase order finance, higher risk there, so that would be 5%. Expansion capital, here you would see the term now extending to between 12 and 48 months. That would be secured, and there we get to a prime plus 8 per year, which is great. That would be more or less 15% per annum, and if you obviously do the calculation, you will get to a substantially lower monthly rate there. However, it is charged, it is accumulating monthly, but over the annual period. And last but not least, you'll see commercial property finance. Now, this is very, very interesting. This is a specific product by one of our funders. where they partner with the individual. They take an equity portion to secure the investment. They supply up until 80%, if not 100% of the purchase price. And ideally, you then pay rent. There must be a rental agreement between you and them, and a component of the equity they ideally want to be bought out over a term of 5 to 7 years. However, that would actually be 7 to 10 years, because the first 3 years you are not required to buy out any equity. So there you'll see prime plus 2% with the property cession, which is a very competitive rate. So that is something to consider. Here again, you have the timeline. So we have higher interest rates. In other words, it's higher cost in capital. However, it's easily accessible. It's within paid out within 48 hours to 3 weeks, depending on the amount and the type that we want to access. Application packaging requirements a lot less. You'll see they do not want a business plan for the short term or a financial model. So that obviously saving companies valuable time and money that they would have paid to professional services. So 6 to 12 months bank statements, latest annual financial statements, management accounts, and respective purchase orders or invoices if applicable to the type of finance. So yes, again, short-term finance is not geared towards the early stage guys. You do need a track record, and that would be towards the growing and established companies. Application packaging for long-term funding. Here we move into higher amounts. So in terms of the short-term funding, that would be anything between 50,000 Rand and 3 million Rand. And that is over a short term of 90 days, whereas the application packaging requirements for the longer term, that is over up until anything from a 24 to a 48-month period, and that can go up until 25 million. So you see that the amounts accessible is a lot higher as well. Due to the amounts being higher and the term being longer, here you do require a comprehensive business plan and a 3 to 5 year financial model, including a due diligence pack or documents as required by the specific funders. Here, just a short summary of a mandated short-term funder that we have on the books. Here you'd see a minimum of 1 million and a maximum of 25 million. The funding needs to be triggered by growth and not distress, so they're not into distress funding. Applications must demonstrate an immediate opportunity or a viable growth strategy, demonstrate excellent leadership and management skills, so they place a high value on the jockey, demonstrate the affordability of funding required, and the business must have an annual turnover of more than 10 million. So I want to highlight that this specific funder is in the short term as well as in the long term debt game. But for this specific one, it's aimed towards larger companies with a minimum turnover of 10 million. So that's very important to also understand the minimum criteria. You don't want to be expending time and resources on applications, because the application process can be quite tedious and lengthy. So it's important to know who do you fit, who is the right fit for you, and to then make sure that when we apply, we are eligible on the minimum criteria. And medium-term funders, here it is anything up from 500,000 to a maximum of 25 million. Again, this is just examples of some of the programs open under the short and medium term. This is not all of them. This specific product is aimed towards infrastructure, and the fund offers startup capital and expansion capital, equipment finance, property finance. It invests in viable infrastructure and manufacturing businesses within the following sectors. You can identify yourself there: green industries, new technologies, engineering, agri-processing, ITC, textiles, clothing, automotive, chemical. This would include plastic manufacturing that normally falls under the chemical component of the index list. So yes, one thing that I do need to highlight with the debt funders, they do not have the empowerment and the impact mandate. Here they look purely at affordability and the ability of the company to repay the loan and to generate growth and revenue. So this would be ideal for companies that say, listen, we have a shorter lead time. We do not want to jump through all of the hoops to prove our impact, our BE, our rural development and all of that. This would be ideal for companies within that segment. Each application, if we look at the criteria, is considered on the merits and the potential profitability and viability of the business. You need to prove a good internal rate of return and healthy cash flows that directly linking to your ability to repay, demonstrate excellent leadership and management skills, have a proven concept. It's very important that we are ready for market, or we have a service that is already commercialized and have a reasonable offtake arrangements in place. This I mentioned earlier on, there's a segment that bridge between the early stage and growth where you are not breaking even, but you do have market traction and you can prove offtake agreements or a large contract of the sorts. You would then qualify for this specific funders product. They give additional bonus points and focus on if you can replace an import business. In other words, it would be a product that we as a country have an import excess of. We need that, so it's a product or a service that we acquire from other countries because we don't have enough manufacturing or production of that specific product in South Africa or within our region. So that's an additional bonus. Also, if your product is a product that has an export focus, that's also great. That's additional bonus points in terms of this specific funders criteria. And then they also support businesses with high technology component to the service or product. A lot of the guys jumping on the technology component, as that is directly linked to the ability to scale. So just want to see that. So that would be an example of the medium term, a short term, and also then that would be the components for the debt funding. When looking at venture capital and private capital, venture capital and private equity, instruments available here is a structured debt instrument. So that would be equity component, shares that they have, but also perhaps a component that is debt. This would be equity investments or ideal for mergers and acquisitions. So here they focus on the management team, high profit margin, fast-growing market. They want to identify opportunities in industries that's expanding at the moment and not contracting, that has the availability to scale and attain a market share and is driven by IP or innovation or has a unique selling point. So that's what the venture and private capital companies are focusing on. When we are looking at the requirements, funds normally have a strict mandate as to what type of investments they can invest into and what not. This is industry specific, region specific, To give you an idea in terms of industry, the mandate for a specific funder would probably be active anything from a 12-month window to a 3-year window, where they as a fund make the executive decision that they will only be investing in green energy, for instance, or that they will only be investing in manufacturing, or only be investing in agro-processing, or in logistics, or in healthcare, and or. So it's very important to know who you are a good fit with, and what their requirements are to access funding. When we region specific, some of the funders are only in South Africa. Some of them have African up in Africa as a whole, and open to expansion across border. A few of them look at international expansion, but that is very limited. Ticket sizes vary. Ticket sizes is the lingo we use in the industry to say the amount that they are willing to entertain or to then invest, and that will vary from 1 million to 200 million plus. We've seen very, very large amounts. When we look at international investors, they do not entertain a project or business if the minimum amount of investment is not $5 million, that equating to roughly 75 million rands in South Africa. Normally private and venture capital individuals or investors would not take a majority stake. This is to limit the exposure. They take anything from 5 to sometimes a 50% or 49% or however else, often a lot less. It would normally be in the range of a 25 or 30% equity position, just enough to influence the board and influence the direction of the company, but not enough to overexpose them within the specific company. So that's everything that we need to consider on the venture capital side. Here, timeline, we have to consider it's anything from 1 month to 4 months. The component that normally takes the longest here is the deal due diligence. From our side, we understand what our mandated investors want. So we pre-package that, and that often shortens the lead time to access capital. But here they would look at a property valuation if that is part of the finance. FICA and vetting is important. Market analysis and placement, very important. The marketing, sales and action plan. A lot of focus on the team, its ability to take the product to market, to generate the profit margins that we are projecting, and to then bring that return back to the company with active management. Some of the components we spoke about at the top, bringing down the per unit cost, and here full 5-year financial model, letter of intent or offtake agreements, and also a pitch deck. So that would be something that's different. Here you would actively have to pitch your plan or your expansion to the specific investor. Last component, I see we have about 20 minutes and then our time is up. So I am going to finish off with the financial ratios. Funders consider different financial ratios depending on the type of the funder, whether it is debt or equity, and the type of funding under consideration. So here it's very important to note that there's industry benchmarks. Please benchmark your industry, compare yourself and your financial ratios to your industry when looking at accessing finance, and to know where you should improve, and obviously in light of what we are going to share with you now. When we look at obtaining debt finance, the most crucial metric for a lender here would be the debt ratios. This measures the extent to which the organization uses its debt to fund operations, what room they have to take on more debt, and highlighting the company's financial risk. Financial institutions consider a debt to capitalization ratio and or a debt to equity ratio above 0.6, meaning 60%, as high risk and over leveraged. So here you would ideally have 30% or 40%, and that would provide you with a window to increase your debt another 20% up until the 60% window. In terms of equity and venture capital, the metrics that we focus on is mainly the profitability matrix, but we'll get into that in a moment. When we look at liquidity ratios, we are going to cover the vital liquidity or the vital ratios, tell you or show you the equation, what we consider when we calculate that, and also give you an indication of what is a good ratio, what's not a good ratio, and how to interpret the ratio. So when we look at and when we assess our clients, we often look at the current ratio. This is taking the current assets and current liabilities, and this tells us, can the company satisfy the immediate and current liabilities, and also shows us what room they have to take on more debt. So this is on the liquidity ratios, specifically speak to the health of the company and also whether or not we can take on more debt. So in terms of this, a good ratio here would be between 1.2 and 2. The current ratio is the ratio that measures the ability of the company to repay short-term debts, which are due within the period of 1 year. So that's why it would only be current assets and current liabilities. That would be all assets and liabilities that manifest within the next 12 months of the company. When we look at the cash ratio, this is very interesting. Current assets is cash and cash equivalents, so that should be noted. That would be your debtors book, obviously cash on hand, cash in the business, and a good cash ratio is anything from 0.5 to 1. The cash ratio is a liquidity measure, and it shows the company's ability to cover the short-term obligation using only cash and cash equivalents. You'll see that inventory has not been included in that calculation. Inventory is considered not as liquid as cash, and depending obviously on the industry that you are in, you might have a niche product. It's something that, although it is an asset, it is difficult to sell in the short term. So that is why inventory would not be regarded as part of the cash ratio current assets. When we look at a quick ratio, this is also called the asset ratio test. It is current assets, which includes cash equivalents and your accounts receivable, so that would be your debtors book, over your current liabilities. A result of 1 is considered to be normal quick ratio. The quick ratio is a calculation that measures the company's ability to meet short-term obligations with the most liquid assets. So more or less, the ratios that you see here differ slightly from one another, measuring different aspects, but it's all ratios that we consider and that funders consider when looking at extending additional debt. When we look at solvency ratios also a large focal point for debt funders. Your debt ratio, speaking to your total liabilities and assets, this asking, are we solvent? It's the solvency test. The debt ratio measures the amount of leverage used by the company in terms of the total debt to asset ratio. A debt ratio greater than 1 tells us that the company has more debt than assets, and that in terms of our interpretation of the insolvency law in South Africa, you would then not be a trading or solvent company. So debt to equity ratio, That would be the next. And this is, you'll see we've referred to this specific metric throughout the presentation. And this is something that funders, whether it is equity and or debt, take into consideration to say, what is your skin in the game? And it also tells us, is the activities or the operations in the business funded by external money, money of third parties, or by the owners and or shareholders of the company. So the optimal debt to equity ratio will vary widely from industry to industry. Generally, a good debt to equity ratio is less than 1, meaning that your total equity, your total debt is equal to the total equity. However, depending on the industry, especially some of the heavy asset, fixed asset industries, mining, manufacturing, this ratio can go as high as 2%, but this is rather an exception to the rule. So it's very important, as we said from the get-go, to please benchmark your ratios to that of your industry. That's easily accessible via the internet. There's a few websites that provide you with market insights. Equity ratio, a good debt to equity ratio is around 1 to 1.5. The shareholder equity ratio shows how much of the company's assets are funded by issuing shares rather than borrowing money. And then the interest coverage ratio, this is specifically towards the affordability element, to say what can the company afford, can we cover the interest of the loan that we are, of all of the loans of the company. So here we take the EBIT, not the EBITDA, and that would be earnings before interest and taxes, and we then divide that over the interest payments. So a bad interest coverage ratio is any number below 1. A company's interest coverage ratio determines whether it can pay off its debts. Creditors use this ratio to decide whether they will lend to the company. So the solvency ratio there being very important. When we look at profitability ratios, this is ratios considered by equity investors. That would be your net profit margin, the gross profit margin, the operating margin, the return on investment, and the return on equity. And one that we have not included here is the internal rate of return that we will discuss in a moment. Net profit margin, a good margin will vary considerably by industry, but as a general rule of thumb, 10% net profit margin is considered average, and a 20% margin is considered good. Something to consider here is whether you have a high volume business or a low volume business. If you do specialized items, the profit margin would probably be within the 10 to 20, but if you do low margin, high volumes, that equation would differ. When we look at the gross profit margin, this margin will greatly differ from industry to industry again. However, margin greater than 45% is generally considered good. On average, we see profit margins within the manufacturing and retail space, or wholesale retail rather, to be within the 30% margin. Operating margin, this ratio reflects the percentage of the profit that the company produces and identifies what component or percentage of that is actually generated from operations, and this is calculated prior to subtracting taxes and interest charges. When we look at the return on investment, this is a primary metric that would be considered by investors. A return on investment greater than 15% per annum is regarded as a good investment. This, however, remains subject to the performance of other stocks or opportunities in the market. For instance, what would be the repo rate at the current stage? So investors on a high level would consider, if I take my money, I put it into the bank, which has no risk. What would be the return or the interest that I would be able to generate from that amount of money? They then adjust or discount the entrepreneur in terms of risk and add to the percentage that they need to justify the risk that they are taking. So that would be the return on investment. When we look at the return on equity, it's our net profits over our total equity, and this measures the profit as well as efficacy of the company. How effective are we with the equity that we have employed or the investment that we have made? A rising ROE suggests that the company is increasing its profit generation without needing as much capital. It also indicates how well the company's management deploys their shareholder capital. So that would be the return on the money invested or the equity. In terms of the internal rate of return, that is a metric used to measure the cash flows of the company and also the overall health of the company. That would definitely be a component that would be scrutinized by investors. In terms of the funders considered different ratios, let's see if we can access that. It seems that our link here is not working, but it would have just been a visual of what we just discussed in terms of ratios. And for sake of time, I'm not going to do that, but we will add that onto the circulation of this presentation. What's very important, lastly, and this is our last component, is what you need to submit or have in your business case. Overall, it's the executive summary. This is a structure for you to follow. Next would be your ownership structure and profile that you need to dive into, a proper market analysis. Who's who in the zoo, who's the competitors, how do you compare to your competitors, what is your value add, what is your unique selling point, and where you place yourself in the market, what is your market share. So that would be everything under the market analysis. When we look at technology and production processes, this will specifically be when we are accessing infrastructure or any finances, long-term finances. This, just to note, just to take a step back, the business case, if it's not a packaging requirement as seen throughout the presentation to access that specific funding vehicle or mechanism, it's obviously not applicable, but the business case would be for grants, it would be for any government or quasi-government, it would be for term loans or larger loans that you would have to substantiate. So pretty much everyone except for the short-term financiers. So technology and production process, very important. They require graphs, factory layout. They really go into substantial detail there. Management and human resources, I cannot highlight this enough, the importance of that. Full CV, full spec in terms of what you can and cannot, what your team is capable of, the different skill sets, financial, operational, industry experience, all of that will have to be demonstrated. Corporate governance, again, very important. This is crossing all of the T's and dotting the I's in terms of compliance, whether it is tax compliance, legal compliance, licensing within the specific industry, if it is required, associations, accreditations, and all of that. Raw material supply. You will have to be able to demonstrate a consistent supply of whatever material you need to have your business function. Again, here, differentiate. We need to ensure that we don't have one supplier that is seen as a high risk and will be flagged by all of the funders. So be sure to have different suppliers. Obviously, when it is a specialized or niche product, we would have only one supplier, but with the option then to also pivot to whether it would be an international supplier or however else. We just need to demonstrate that you have done the research and why you have selected the current supplier, whether it be for quality, for price, or however else. When we look at location and infrastructure, this often seems quite frivolous. However, specifically with the government and quasi-government funding, it's part of the auditing process. They go out to the specific location, they inspect the infrastructure, and it is very important for them also to see where you are located, how that would impact your surrounding environment, whether it would boost rural development. Let's say, for instance, the unemployment rate is higher in the Eastern Cape. It would then be more beneficial for their mandate to place a factory within the Eastern Cape than, for instance, in Gauteng or however else. Environmental and regulatory requirements, you will have to demonstrate that at length. Financial information and forecast, that being the pivot of the specific business case to prove the sustainability and viability. Last but not least, the risk analysis. You have to demonstrate as the entrepreneur or as the key individual that the company has the foresight to identify risks and to then institute a mitigation or action plan on how to deal with those risks. And then obviously the conclusion we normally do to say that we have met the minimum requirements of the specific funder, we are within the financial and risk parameters, and that we wish that the application would obviously satisfy them and would please them for them to extend the monies. So that's in terms of the business case. The last slide we have here is just the executive summary. I think all of the other components are quite self-explanatory, but I want to highlight that your executive summary is absolutely that's going to be your first impression. Most funders only read the executive summary, so it's very important to make sure that what we have in the executive summary speaks to that, and that we do communicate what we need to communicate without duplicating it throughout the rest of the business case. So here you would state the business, whether it's a startup, operational, existing, give some background or history, your growth specifically, where you are geographically, and how long the business has been operating for. The industry in which you operate, give some background about the industry, what's the industry size, what is your market segment of that industry. Take that back to the products and the service that you offer, outline, sorry, my apologies, your expansion and startup plan and the amount of funding that you will be requiring. So here, separate to that, I would have a funding breakdown. For instance, we will need 1 million for operational capital and working capital to pay salaries and we will need 2 million to get inventory or to get the licenses we need to import. A full breakdown or a high level breakdown rather, with that directly linking to the financial model, also contained in the business case. Other material issues, such as the number of existing and new jobs to be created. This would be focusing primarily on the mandate of the specific funder and motivating why your project is a good fit for their mandate. And obviously the new and existing contracts or letters of intent that you have secured to prove that this is not only Excel million and pie in the sky, but that we do have a substantial business with projections that is tangible in terms of the execution of that. So that is it from us from Venncap. I'm going to be answering a few questions. I see we've made our time, which is great. Yes, Caroline, good morning. May we please receive the presentation or the slides on an email? We are going to arrange that with SIFSA and ask them to forward the presentation as well as the link that we promised. So we will definitely be doing that. Let's see, any other questions? Ingrid, thank you for inquiring. Is there a price list for our services? You are welcome to go to our website. There is a price list for that. In terms of the funding that fits, that's a free service that we offer or that we will be offering via the link. So we implore you to please make use of that. From there on, we will do a formal funding recommendation. From that, we will be reviewing your financial statements and really diving into all of your calculations to make a formal funding recommendation. There is a fee attached to that, although it's a minimal fee, but we will be extending our price list for the services with the presentation. However, you are welcome to have a look at our website. We do have an online shop as well. We cater for all legal, financial services, policies for companies and all of that. So please have a look at that, depending on where you are in your life cycle, with our main focus obviously being on getting you investment ready and then accessing the finance and capital that you need. Another question here. Good morning all. I'm joining now. If you could share with me the presentation and more information. I was looking forward to join early, but due to pressures, I could not. Representing docs. Thank you, Mr. Zungu. We will definitely be extending the presentation. Thank you very much. I take it as website www.venncap.co.za. Thank you, Ingrid, 100%. Thank you also for sharing that with the rest of the attendees. Wonderful. Guys, any feedback on the presentation? We would greatly appreciate that. We really do want to ensure that when we have the sessions, that it is something that adds value, that it is something that answers all of your pertinent questions, and that is not a waste of anyone's time. So if you have any recommendations or any notes or that you want to share with us, please feel free to do so privately or publicly. That's absolutely fine with us. From my side and from Venncap's side, thank you so much for your time. I hope that we get a lot of MatchMe applications. As I said, that's absolutely a free service that we are extending due to our partnership with SIFSA, and we would really like to help you navigate the initial landscape and provide you with some options to see what would be viable for your company. Great, guys. Thank you so much. We are going to be logging off. You are welcome to also extend an email to Janae at venncap.co.za. That is spelled J-E-A-N-E, Janae. And or alternatively info@venncap.co.za. But we will be extending all of this information via email, and yeah, we hope to see you in one of our sessions soon. We will be covering future elements or sessions on topics required by CIFSA members. Kimon, thank you so much. Is there any way to get access to watch the recording of this presentation? 100%. I will organize that with the team on CIFSA's side. They have made provision for our recording, so I believe that would be possible. We would definitely be sharing that. That might even be better than just sharing the presentation itself. Great, guys, thank you so much. It seems like that is all of the questions. You are welcome to reach out. You can see there at the bottom of the page, we have our email, info@venncap, as well as our office number. You are welcome to reach out at any time. Thank you so much.